Hello, we are here on video 4 for chapter 8, and we're continuing our discussion of the expenditure cycle. So we are up to substantive tests, right? So there we go. We're wanting to keep audit risk very, very low. So we understand inherent risk, and we understand control risk, and now we are over here to substantive testing, right? In order to keep our detection risk low, we are going to use our substantive tests to do more or less testing, but we're definitely going to do some substantive tests. So here's the first thing we're going to try to do. As an auditor, the most important thing is this completeness insertion, right? As on this cycle, right? It's not always for every account, but for accounts payable, we want to make sure that they're complete. We don't want them to be understated, which means we're going to have to find any unrecorded liabilities. All right, so that sounds tough. It's like, hey, they haven't recorded them. What are we going to do? Well, we can inquire of management about how they identify and record liabilities, and then we can see if they're doing that. We can scan the open purchase order file. It could be that something's been received that they haven't put down as a liability yet. They're just keeping it in the open order file, but they haven't really recorded it yet, but they should have. We can look for unmatched statements receiving reports. That would tell me maybe we got an invoice, but we haven't written it down anywhere, so we owe it, but it's not in the payables. I can trace anything unpaid to the receiving report. I can confirm with parties, and this is an important step. You may recall in accounts receivable, we talked a lot about confirmations. Well, this would be a great way to find out if somebody they normally do business with has been understated. So your client is going to have some vendors they typically use all the time, right? They always get this part of their inventory from this vendor, and they always purchase these supplies from that vendor, right? So there's going to be certain vendors they use a lot, or this certain set of rotating vendors. And even though it may show a zero balance, they may actually owe them some money, right? That's the point. We're trying to find out, oh, is this understated, right? So we'll just get a list of all their typical vendors who they use, and we'll send confirmations to them and say, hey, your balance shows this, so zero. Is that really true? And believe me, if they actually owe something, you'll hear back, right? So confirm balances, and especially with zero balance accounts, because those are the ones that are going to be understated. You can review cash disbursements after year end, right? So if they said, oh no, we have no account payable, right? They've understated their liability. It's incomplete, right? But then they made a payment to someone after the next period. That was probably a liability in the preceding period. If they paid it on January 2nd, they probably owed it on December 31st, right? So that would be a way to look. You need to, in addition to completeness, we have to test for cutoff. Did it get in the right period? Well, so what you're going to do is you're going to pull those receiving reports and the invoices that are right around that period end, right? They're around, end of December. Let's say if it's December 31st year end. And you'll make sure that they're in the right year, right? Because if you received it on December 30th, you have the liability. You may not get the invoice until January 1, so you want to pull some of those January invoices and see when they received the goods. If it's been received, if it belongs to the client, they owe the liability, whether or not they've gotten the bill for it or not. So we're going to talk about some other accounts in this cycle. We're going to talk about prepaids, accruals, expenses, and then inventory PP&E. So first we want to talk about auditing prepaids. Prepaids are pretty typically the same thing every year, so what's nice about prepaids is you can make a little schedule and look at last year's schedule, see if it's great, because you're gonna have rent, they're gonna have taxes, they're gonna have office supplies, they're gonna have insurance, all your typical prepaids that you might pay up front will be the same every year, and they should probably be about the same amount unless. And so you could do some analytical procedures and just see, well, I think their prepaids will be this, compare them. They should have a schedule, you can verify it, something like that. But you should be checking prepaids. Those would come up in this part of the cycle. Accruals. So, unlike prepaids, where there's usually a schedule that's an asset, they don't want to understate them. Accruals, things like salaries payable, taxes payable, interest payable, those things sometimes aren't invoiced, right? So when you purchase something from a vendor, they send an invoice, they want to get paid, right? But salaries payable, your employees aren't sending you an invoice to get paid. Your tax, you usually do get some kind of tax bill. But it usually doesn't come till like the end of the year or so, the next year even. So you got to keep up with that. Interest, you don't really get a separate bill for interest. It just kind of comes out of your payment whenever you make that payment. So you, as an auditor, have to search for any accruals that they haven't made. So you want to make sure they're not understated. Again, typically nobody's going to overstate an accrued expense. They might forget them and understate them, or they might purposely understate them, but typically they're not going to be overstated. So you're testing for completeness. So you're going to do things like check the tax records. You can go to the public tax office and check anybody's taxes, so that's easy enough to find out. Wages, it's pretty easy to find out when their payday is. So most of the stuff you can do. Interest, you can see what loans they have, right? So they should have their long-term liabilities, and you can find that out. You can also find out from confirmations with their lenders, right? Typically when you do your cash confirmation, you also ask what loans they have. So once you know what loans they have and you know what interest rates, it's very easy to calculate principal times rate times time and come up with what their accrued interest is. So you can typically find these out. They're some pretty standard accruals, and you can usually figure them out and check and make sure they remembered to do that. All right. So how to audit accrueds and prepaids, agree with prior years. Again, accruals and prepaids are kind of very typical, rent, salary, interest, taxes, very easy things to track down and looking at that, recalculate, do some analytical procedures, just like I discussed. Very easy to do. You can usually figure out from prior years what their accrual should be this year and the prepaids. Now, income taxes payable. As an auditor, this part of their liabilities, so not property taxes, income taxes. This part you're going to typically bring in specialists. For these big public companies, they have all kinds of tax people doing all kinds of interesting things. So they're in multiple jurisdictions, right? There's not just federal. There's state and local, SALT as they call, state and local taxes. Typically, you will see what they say they owe. You will look at any correspondence. You will vouch to see that they did pay those liabilities after the fact. But typically you're going to bring in your tax specialists to help you with that. All right, so with that, we're going to stop and move on to substantive tests for property, plant, and equipment and finish up the chapter here. All right.